Welcome to Alpha Recap, your quick post-market rundown from stockalpha.ai. We're unpacking the last 24 hours in the markets and what it means heading into the weekend. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Lots to chew on today. A narrow rally led by Nvidia and chip names, a hawkish Fed narrative that surprised some, and a messy set of microcap collapses that showed two very different dynamics. So, what really stands out here is...
Right. The headlines were concentrated. Markets closed with headline gains, largely driven by Nvidia and a few AI and chip-related names, while Dow futures nudged lower ahead of the long weekend.
Yeah, and the contrast was striking. On the surface, indexes looked okay, but underneath, there were these pockets of real stress in tiny, thinly traded names. Honestly, I was a bit surprised by how extreme some of those one-day moves were.
Let's break that down. First, the narrow rally. Analysts flagged Nvidia as the exemplar, part of a small group of large-cap names that pushed returns. That kind of concentration can lift headline indexes, even as market breadth weakens.
Right, and when a few names carry the market like that, it creates fragility. If leadership fades, the rest of the market can get exposed quickly. You get index gains on paper, but loosening internals.
Analysts even pointed to some valuation data points to watch. Roughly 61%, about 27%, and nearly 0.1%. Numbers that signal different valuation dynamics within that leadership group.
So, when you step back and look at this, those percentages are shorthand for how stretched certain metrics were. Not a verdict, but data that suggests concentration risk.
Exactly. Now, second big theme, the Fed narrative. Coverage over the last day suggested a more hawkish tilt than many had expected from what had been described as a Trump-era Fed pick. That undercut hopes for easier policy.
Which matters, because hawkish signaling pushes rate expectations higher, or at least higher for longer, and that compresses the present value of far-out earnings. Growth names with long-duration cash flows feel that most.
Right. Higher rates act like a bigger discount on future profits. So the math just makes high multiple growth stocks more sensitive to changes in rate expectations. Analysts repeatedly noted that point.
And there's debate about how durable that hawkish stance is. Some think it's a true pivot, others treat it as more episodic. The market's reaction depends on which view wins out.
Now for the third theme, microcap volatility. We saw a string of brutal one-day collapses in very small names. These weren't all the same story.
Right. One stock fell about 15% to 2 cents on roughly 867 million shares. Another plunged about 37% to 12 cents on around 378 million shares. Yet another dropped about 38% to 5 cents on about 5,000 shares. And another slid about 38% to $1.80 on roughly 2 million shares.
Those examples matter because the volume profiles told different stories. When you see huge volumes, like hundreds of millions of shares, that often signals forced selling, margin liquidation, or conviction-driven exits. With tiny volume, price moves can just be liquidity-driven gaps.
Exactly. Conviction versus liquidity. If a stock cratered on heavy volume, that's a different risk than a stock that gaps on almost no volume because the order book was thin. Execution risk there can be brutal.
Short reaction.
Big move.
Not what anyone expected.
And to add to that, spreads and slippage in ultra-thin names can make exits cost a lot more than headline percentages imply.
Okay, let's walk through where analysts largely agreed and where they differed.
Areas of agreement. Concentration risk was flagged broadly. The narrative around policy sensitivity was unanimous, And everybody stressed liquidity, that volume profiles matter. So those are the three solid common threads.
And on the disagreement side, people argued about whether the Fed signal is a durable hawkish pivot or just noise. There's also debate about whether narrow leadership will eventually drag broader markets down, or whether capital can stay concentrated in a few high-conviction themes for a while.
Also, analysts split on whether the small cap collapses were contagion across the microcap space or just idiosyncratic events. The mixed evidence, heavy volume in some names, almost no volume in others, keeps that question open.
Let's explain the Fed duration link in plain terms for listeners who aren't deep into bond math. Higher interest rates raise the discount you apply to money you expect to get years from now. So the more a stock's value depends on far future earnings, the more it gets punished by higher rates.
Right, and that's why analysts say long-duration growth stocks are most exposed. It's not just theory. The market's been showing that sensitivity lately.
Back to Nvidia and narrow rallies for a second. When a handful of names lead, you can get big index moves even while mid and small caps languish. Index-level calm can mask real pockets of risk,
Which matters for anyone with broad exposure. If you're indexing, that concentration can mean you're effectively overweighting whatever those leaders are, even if you didn't choose to be.
Let's get practical. Implications by investor type. I'll kick off with long-term investors. Analysts suggested sticking to fundamentals and not overreacting to one-day microcap chaos, unless the underlying thesis for a holding truly changes.
Income and conservative fixed income folks. A hawkish tilt supports higher yields and can pressure bond prices. Analysts say it's worth re-examining duration exposure. Not advice, just mechanics. Longer duration bonds lose more value when yields rise.
Growth-focused and thematic allocators. The concentration in AI and chips means you should actively monitor leadership names' technicals and fundamentals. Narrow leadership raises the importance of stress testing your allocations for a reversal.
Short-term traders and volatility seekers. The small cap swings created trade opportunities, but also real execution risk. In thin names, slippage and not being able to exit quickly are real hazards.
Speculative microcap holders, position sizing, and liquidity awareness are critical. A 30 to 40% one-day move fundamentally alters risk profiles, especially when you can't tell if selling was systemic or company-specific.
So what should people watch over the weekend and into the next session? First, headlines. Markets reopen Sunday evening ahead of Monday, and weekend news can set the tone right away.
Second, volume on reopening. If those microcap names see follow-through volume, that suggests continued conviction. If volume is light and prices bounce or mean revert, that points to liquidity-driven moves.
And third, any Fed or macro comments that reinforce or soften the perceived hawkish stance. That will be watched closely by growth and duration-sensitive traders.
Also, keep an eye on sector rotation signals. If financials start outperforming long-duration growth names, that could indicate capital moving from growth into cyclicals or value.
Let's wrap with some strategic considerations analysts described. Informational, non-prescriptive. First, stress test exposure. If recent volatility exceeds your tolerance, reassess position sizes.
Second, prioritize liquidity where it matters. Execution risk in thinly traded names can blow up perceived returns.
Third, monitor breadth and leadership. A continued divergence between narrow leadership and weak breadth raises the chances of a sharp correction if leaders falter.
And fourth, hedge and manage duration exposure if you're sensitive to higher for longer rates. That could mean different non-personal hedging mechanisms depending on your situation. Again, analysis, not advice.
Quick reactions.
Yeah, that tracks.
Right. Good checklist to have.
Final takeaways then. 1. The last 24 hours showed headline strength concentrated in AI and chips, with Nvidia front and center. 2. A more hawkish policy narrative popped up, and that changes the math for long-duration growth names. 3. There was a wave of microcap collapses that split between conviction-driven heavy volume selling and liquidity-driven thin volume gaps.
In short, headline stability coexisted with real pockets of risk. Analysts note that parsing volume, breadth, and rate expectations is key to understanding where volatility and opportunity are most likely to show up next.
Thanks for listening. If you want to dive deeper on any of these points, head to stockalpha.ai. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
And remember, this is informational only, not a recommendation to buy, sell, or hold any security, and not personalized advice. Talk to your advisor if you need tailored guidance. See you next time.